Let's once again ask questions about resilience in the US economy and cracks in it. And I suppose it's the cracks that have really dominated the headlines last Friday and into Monday. But yesterday we got a little bit of reassurance from the claims data playing an outsized role for markets.
Absolutely, and it shows how kind of structurally problematic this market is, not this economy, that we saw such an outsized reaction to what is normally a second-tier print. It's a volatile print, and, you know, it wasn't necessarily particularly out of line given that volatility. So this shouldn't have been an amazing number, but yet we saw a very big market reaction. And that gets to the point here. There's, the recession risk fears got completely overblown over the last couple of weeks. We went from a month ago to being completely complacent to suddenly panicking about a hard landing where there's very little sign of that data. The Atlantic GDP Now Fed tracker has us tracking at almost 3% growth. It does not look like we're anywhere close to a recession. And therefore, unless there's something suddenly on the horizon that I'm just not seeing any sign of yet, I think that all these panicked rate cuts that are priced in the market look completely bonkers. The Fed might get away with maybe one rate cut, but maybe not anymore this side of Christmas.
Possibly one rate cut. Aaron Capitan of UBS saying that this was a head fake as well. So agreeing with you on that front, Mark. Talk to us about how this all ties into the rebound that we saw, pretty pronounced rebound in US stocks yesterday. What do you read from that as you kind of point to some of the tensions in these equity markets at this point?
Yeah, I think this is really important. Equities is very rarely an exact encapsulation of economic strength in the short term. Now, obviously, they're linked over the longer term. And I think that the market in August will stay volatile. I think the power of the rebound yesterday, the largest, the best performance, daily performance since November 2022, but still down in the week, shows a market which is now going to whip around a little bit more. So I expect that we're going to see some more losses in stocks the next coming weeks, but not dramatically so. I'm not suddenly bearish stocks. I think that overall this will probably provide better opportunities to buy stocks for the year end, in fact. I think that'll come in a backdrop, though, over the coming weeks as we reprice yields higher, and that's why stocks are going to be under pressure over the coming weeks. So economy is fine, but stock market just got a bit of ahead of itself, got a bit more volatility ahead.
So that's your view. The economy is fine then, Mark. But what are markets pricing? And when we look at different markets, bond markets, equity markets, are they pricing the same things?
They're most certainly not. So bond market is pricing a pretty firm landing. A very clear recession is what the bond market is pricing. And we're paring back from that, but we still got more to pare back from that. On the flip side, stocks were very clearly up to a few weeks ago pricing no chance of a landing, and still probably pretty close to a soft landing. At the moment, they are not yet realigned. Stocks are pricing growth to be okay. Bonds are pricing growth to be pretty bad out there and much worse than is the moment. Which will it correct? I think it'll be bond markets that correct to stock markets, and I very rarely favour equity traders over bond traders.